Ladies and gentlemen, thank you so much for joining us. I'm Frank Chaparro, Director of News at The Block, and this is The Block Presents Developing a Digital Asset Strategy, brought to you by our friends at Paxos, which this morning announced a very significant Series C. You can check out that story on theblockcrypto.com under the byline Frank Chaparro. But anyway, stay here for the webinar first. You can read the story later. We've got a great lineup for you today. We've got Caitlin Long, CEO of Avanti Bank. We have Sina Nader, the newly minted COO of FTX US. Andrew Peel, a dear good friend of mine, head of digital asset markets at Morgan Stanley, joining us from across the pond. Andrew, so great to see you. And
likewise,
your beard. And then, of course, Walter Hessert. We saved you for last. We don't want folks to think that we're favoring our sponsor too much. He's the head of corporate strategy at Paxos and is probably best known at the firm for kind of rallying behind this strategy to onboard fintechs onto their white label platform. So he's kind of the brains behind that operation, and we'll definitely dive into that. Well, folks, thank you so much. It's been I don't know about you guys, but I probably netted an average of 2.5 hours of sleep a night. I think I went to bed at around 2 a.m. and woke up at about 5:30. I had my alarm. Then went back to sleep. Woke up at 8 to the sound of my neighbor mowing his lawn, and we've just been at it, all of us. So let's start there. Over the past couple of weeks, we've seen Bitcoin run up to well beyond its 2017 levels. Are you hearing from folks or folks reaching out who are maybe not in the crypto space? I think the answer is probably obvious, who are now dying to get in. We can start with you, Caitlin.
Oh, sure. Yes, of course. Yeah, all of us, I'm sure, are experiencing that. Certainly friends and family. A lot of folks who were skeptical have been awfully quiet. We're hearing crickets from Nouriel Roubini and those folks who've been big skeptics. And I'm waiting for the next round of Bitcoin's dead, it's thin air. I've seen a few come out. David Rosenberg, Rosie, this morning. But yeah, perfectly happy. Bitcoin just is. It's doesn't matter. I actually think the price action is in some ways the least interesting aspect of it.
Yeah. So what do you make of all this, Andrew? Are you seeing new inbound queries about the market from either folks professionally or personally?
Absolutely. I think it's across the board the same case. And as Caitlin mentioned, when the price moves, I think people recognize, it didn't die all those times we thought it died, and now it's back again. And maybe there is something there, and we should really now talk about it because it's much higher in terms of values than it was previously. But there's really huge amount of interest, obviously, with the coverage on the media. It's back on CNBC and Bloomberg and across the board in terms of financial press. I love the articles that dig into the details, and definitely to Caitlin's point, it's refreshing to read articles about content and technology rather than the price move. Yeah, loving your block and some of the in-depth articles you guys do for the space. Definitely more welcome than headlines about the price action.
Yes, well, I appreciate that. We care about price sometimes, but as long as you have a balance of different types of stories, I think you're going to serve most folks out there. What about you, Walter? Have you had more firms reach out looking to follow the lead of PayPal and Revolut?
Definitely. Do I have volume? Can you hear me?
Mm-hmm.
Perfect. So thanks, Frank, and thanks for hosting this and having everyone on here. We definitely see more firms reaching out. I would say that's been a trend really all year here. And certainly price is maybe one factor, but probably the smallest of a group of factors. And other factors I think that are really creating momentum are the entrance of offering these types of solutions, getting into the blockchain space, crypto space over the past 6 months. certainly PayPal being a kind of a watershed moment in their launch of. And so all of these are contributing to two things, I would say: new firms wanting to start to focus on this and really put together a plan, a timeline, and bring products to market, figure out the market. And then the other side is there's firms that we've been talking with for the last 12, 24 months, in some cases 6 months, and they are now saying that timeline is expedited, and now there is direction and mandates from either the board level or the C-suite to move and put something into place. And so it's really exciting. I would say we've seen this huge transition from early adopters into mainstream adopters happen in a major way this year. And that's continuing to build momentum. And the price activity is certainly not the most interesting, but it catches people's attention and helps continue to move different firms along.
Yeah, if folks are having trouble seeing Walter or Sina, there might be some bandwidth issues. They probably have their Blockfolio or Coinbase Pro accounts up and are taking a look at the rising prices. So bear with us. One thing that I've noticed over the past couple weeks, and I've reported on, is this trend that we're seeing of banks looking to trial or get back in the crypto custody game, digital asset custody. This morning I saw from the World Economic Forum that Deutsche Bank now has a proof of concept for crypto or digital asset custody, whatever word you want to use. This is something that Caitlin, I know you've been, pioneering on the regulatory side of things. Why now? Is it just because price is rising? Is it because the sell side, or rather the buy side, is so interested in the space now in a way that they maybe weren't in 2017? And then maybe a follow-up question: will any of these guys succeed? Will Deutsche Bank or JP Morgan succeed in doing some sort of crypto custody? Or are they going to need partners like Avanti and others to get it done?
Sure. Yes. What's driving it is, of course, client interest. And of course, that is also a function of price. So the big banks, I think, are responding to their clients across the board asking for it, whether that be retail customers through a wealth management arm or institutional customers through their institutional trading arm. Everybody's looking at it, and they've been looking at it for years. But when we were in the green room, Andrew and I were talking about our Morgan Stanley experiences. They've been looking at it for years. This is not new. One thing that I would say to answer your question about who's actually going to do this and who's actually going to succeed is that the banks are typically looking at sub-custody relationships. They're not looking at building it themselves. And having been on both sides, the engineering is so different and the systems architecture is so different for decentralized systems. The traditional financial system is set up for delayed net settlement of transactions. And that's in part because there are layers of intermediaries in the financial system. And that's the way the systems are architected at all the banks. And of course, that's not how crypto works. Crypto is real-time gross settlement, not delayed net settlement. So you don't have layers of intermediaries. You settle trades in almost the speed of light. And that is just not the way the traditional banks are set up. So I'm not surprised that what's happened is that the crypto specialized institutions, the infrastructure that's built by engineers fundamentally from the ground up for decentralized systems that are real-time gross settlement systems, I'm not surprised that that's where we're basically building a parallel financial system of infrastructure. And maybe at some point the big banks acquire the infrastructure in this sector, but they're not really building it themselves. And in part because the systems are just so different. It's very difficult to plug in a decentralized system to a centralized, layered, multiple intermediary settlement system.
Since the sort of point or focus of this panel is digital asset strategy, and we're going to talk about other segments of financial markets, including fintech and beyond the banks, But if we're going to think about digital asset strategy within a bank, and what we're seeing is, as Caitlin described, these two things happening in parallel, the maintaining of their centralized systems and then partnering maybe with sub-custody providers on this decentralized system. How does that play out over the next year, Walter? You've partnered with fintechs on building out a similar type of strategy on the fintech side. How do you think it'll play out with banks?
Yeah, it's a great question. I think that important to note that we power a crypto brokerage product for firms like Revolut and PayPal, and there is really kind of a robust list of other firms that will be launching a similar solution with. I would also note that we provide infrastructure as well through our security settlement product and our commodities product for large banks and institutions today, like Credit Suisse, like SocGen. And I think that, it's going to play out very similar. I agree with everything Caitlin said. The only other thing I would add is that these firms, it's not really in their DNA to build technology, period. And so in the early days of crypto, maybe 5 years ago, there really wasn't credible, highly regulated financial market infrastructure platforms for them to leverage. Today there is. For example, Paxos, we're a New York trust. We've just submitted our application for an OCC federal trust. And so we're highly regulated financial market infrastructure, and we're at the same time a technology company. And there are a couple other firms out there that are approaching the world this way, and it just makes a lot of sense when these banks are moving into this space to be able to leverage that than to try and build it on their own.
Andrew, you're within the hallowed halls of a large institutional player. Does that resonate with you?
Yeah,
or
I mean,
are these more bleeding edge fintechy people getting a little wrong?
I mean, I would say I definitely agree with a lot of the points, and obviously, people that have come from within large organizations are fully aware of the legacy systems which run a large portion of the organization, and the fact that new technology has to be built to be able to interact with that technology. I will also say that, I mean, as Morgan Stanley, we simply don't have any offering currently in Bitcoin or other digital assets. So to that point, we don't have necessarily the requirement for this custody layer currently. What we are looking at specifically around infrastructure with traditional counterparties. So we had probably back in 2015, I think, to Caitlin's point, we were discussing in the green room, there was a lot of people coming into the organization from startups that raised a lot of capital. They were bringing all of these fantastic, great ideas, but they were really not necessarily in line with traditional finance and weren't able to explain that technology in a way that fits traditional banking or finance. But we're seeing very different things now. We're seeing incoming from major exchanges. Nearly every major exchange globally has some form of initiative around digital assets in some form, and also from significant clients that have an interest in the technology from a fintech play, but also obviously in interest in some of the traditional digital assets. So the conversation is evolving. I would say technology with traditional players and traditional exchanges is something that we probably look to work with those particular players with. And if there is ever a point at some point in the future where there's significant enough demand around some of the decentralized crypto assets, and of course the SEC and the regulators give us the clearance to potentially evolve, then I think it would make sense to certainly look to partner with existing regulated players in the space that have obviously far superior technology in that regard.
Definitely want to click on that regulatory angle later in the conversation. I want to harken back to the Haslion days of the 2017 bubble or boom, depending on your skepticism or not. But when we saw firms coming to the media, coming to folks like me, describing their strategy at the time, a lot of it seemed to be from the banking sector focused on the trading of physical or trading of the underlying assets of Bitcoin and derivatives tied to that market, right? Goldman originally was going to create a desk where they trade non-deliverable forwards, and there were other products that folks were devising. Now, in 2020, we have Goldman and JP Morgan working together on decentralized blockchain-based repo. So it looks different at a high level. We can get into some of the differences that have evolved since then. But Sina, you kind of came onto the scene at your previous firm. Robinhood came onto the scene in 2018 during that boom. Now you're in a new shop. You're at FTX. Looking back, how do you describe the state of various digital asset strategies today relative to 2-3 years ago?
That's a great question. I would say in general, 2 or 3 years ago, it was just not top of mind for most, sort of corporate players and other sort of, companies that are sort of eyeing the space now. And it was almost, people were sort of like almost pushing it aside like it's not really a real thing. Now it's an entirely different conversation. It's not just sort of people with a passing interest. Now they're actively digging in, understanding a little bit more about, why they do need to have a digital asset strategy. It's sort of gotten to the point now where it's something they're realizing they can't ignore. And so I'm happy to say that we're seeing more people, as I'm sure everybody on the panel is, more and more people reaching out from significant names that are realizing they probably need to have something to do here for their customers.
Mm-hmm. How does FTX maybe capitalize on that?
So, we are obviously, focused on facilitating trade. And so we get to see a lot of the flow and sort of how that looks. But I would say that because of that, a lot of institutions are reaching out, on the liquidity provision side and seeing what we can do there. Basically, anybody that would benefit from having exposure or access, I should say, to deep liquidity in crypto, we've seen them start to reach out at sort of at an increasing pace.
Maybe one day Paxos will route some of its order flow to FTX. Maybe that conversation can get started here. You're welcome.
That would be lovely.
Caitlin, why do you think we went from everyone wanting to do a derivative, or maybe it was just innovation theater around crypto derivatives in 2018 to something that seems a bit more serious on the part of banks? I mean, JP Morgan now has its own website for its Onyx platform. There's tons of job ads floating around out there for them and Citi and others. Or do I have my rose tinted glasses on, and is it really just the same, but instead of derivatives, maybe settlement, et cetera?
Well, I think a lot of it has to do with the fact that the infrastructure wasn't ready, and in many ways it still isn't. And that's part of the reason why the parts of the asset owner complex, like pension funds, endowments, foundations, they've historically invested through vehicles like venture capital, but not directly in crypto itself. And a lot of that had to do with the institutional custody layer not being built. And so it was easier to trade futures precisely because you could actually speculate on the price. And obviously, Bitcoin's a volatile asset. It's an asset that can be traded. A lot of people have made a lot of money trading it. A lot of people have lost a lot of money trading it too. But institutional traders, we're looking at those traditional wrappers like derivatives as opposed to actually owning the underlying. We're now starting to see institutions come in and own the underlying. And that's the difference. And a lot of it, compared to 2017, we just didn't have that infrastructure. And I would argue in many ways, we still don't. We still don't have a true bank that banks crypto. Hopefully Avanti and Kraken will be the first two true banks that are actually plugged into the Fed. and we're pretty close, but it's not done yet. And then obviously the SEC just opened up the whole question of trust companies versus banks as qualified custodians. Bitcoin's not a security, so do you really need a qualified custodian? And what is a registered investment advisor's responsibility in Bitcoin custody? Do you need a qualified custodian if it's not a security? Those are still some pretty big institutional questions that haven't been answered, among others. And I think they will be answered by the time the big wave comes, but we're just in the very beginning of that wave now.
In tandem with this price run up, we're seeing more and more headlines around CBDCs. Andrew, I'm curious from your seat at Morgan Stanley. I'm sure there's an increase in interest and more conversations happening about the ways in which the bank can sort of prepare or position itself to engage with these types of fiat currencies that are digital. How does a bank do that, and is it good for Bitcoin?
So certainly in terms of like how do we technically engage, I mean, in as I mentioned earlier, being closely in discussion with some of our traditional counterparties, so like the exchanges. I'm based over in Zurich. We had 2 years ago almost announcement around Swiss Digital Exchange launching as a subsidiary or daughter company of the SIX Group. They recently completed a project with the Swiss National Bank and the Bank of International Settlements, and they tested things like settlement or atomic settlement from fiat currency or digital representation of Swiss franc and a tokenized asset. You saw something similar from the Deutsche Börse and a version of Euro running through some of these private permissioned blockchain solutions. So there's certainly a lot of experimentation going on with some of these traditional players. And of course, sat in the middle of these traditional exchanges and obviously dealing with most central banks, we have those discussions. There's the innovation centers out at the Bank of International Settlements. There's regular contact with other central banks to see how we as an organization would prepare for that technology. And it's very different technology, by the way, from most of these projects. I mean, some are working on projects around private permission solutions. You saw, Monetary Association of Singapore working with the Canadian Central Bank using R3 and Corda, Accenture, Deloitte involved. So still some experimentation there. You see Bank of France partnering with some of the decentralized projects, technologies like Tezos, for example, and the Bank of France. So how do you prepare for that? I think it's certainly a matter of dialogue, engagement, experimentation to understand, how would you adapt to that relevant technology when there is a clear decision on where that technology, what that technology looks like and where that would fit in to the organization. I'm very cautious to comment on the topic of Bitcoin in terms of whether that's bullish or not, but I just think what's fascinating to me is really like all of this, attention from the central banks, all of this focus on the use of this new technology is essentially born out of Bitcoin. I mean, that's what started all of this. And I think it wouldn't be, this central bank digital currency concept wouldn't really be here if Bitcoin hadn't arrived back as a white paper all those years ago.
I guess to be a little more precise in asking the question, does being prepared or positioned to engage with CBDCs then make it easier? Does it kind of add some sugar to the medicine for a bank to do something with crypto itself, or maybe not necessarily?
I think not automatically. I don't think automatically. Mm-hmm. No, I mean, at the moment, the technologies are not related to Bitcoin per se. Yes, there's like a public-private key being used to transact, perhaps, or it could be a permissioned network. It doesn't necessarily mean just because the organization has to build and prepare the technology to interact with a CBDC, they're automatically set up and ready to trade like one of the decentralized protocols.
Mm-hmm. There also is a growing interest in the stablecoin world at the same time. that we've seen interest in CBDCs grow. Walter, is that how much of that is a part of some of the banks or fintech firms you're talking to strategy to enter this market? Are they increasingly looking to white label something like Paxos so that they can have their own type of stable coin within their system to, attract users to their platform, keep them on the platform? What are you seeing on that side?
Yeah, we have 3 products, I would say, that are of very high interest right now that companies can build off of the Paxos platform to take advantage of, and that is custody. It is a combination of custody and liquidity in our crypto brokerage product, and it's also stablecoin. And on the stablecoin side, as you know, we've been very active as a company. We've really been a pioneer in the space in launching the first and one of the only fully regulated, approved by a regulator and overseen by a primary regulator, stablecoin. And we've also been the only firm that's done a white label stablecoin. So we have a couple companies that leverage our infrastructure, a combination of our regulatory stack, as we call it, and our technology stack to power their own fully regulated stablecoins. And that interest has, I would say, similar to our other products and is symbolic of the industry as a whole, has shifted from pure crypto players into non-crypto players. And so more mainstream type companies, whether they're payments companies, global banks, looking and saying, how can we leverage stablecoin technology? And one of the reasons they're coming to Paxos is one, our experience and expertise in doing it. We power about $7 billion in stable coins. We have about $1.3 billion in the Paxos network of stable coins issued today. And we have also been kind of the leader in the regulatory side, really kind of setting the standard for how to be a regulated issuer of stablecoin. And these firms that are now looking at stablecoin are looking at it for not just crypto trading, which is for the most part what a stablecoin has been used for historically, but they're looking at it for payments for goods and services and other mainstream use cases. And I think that I would suspect that more firms will see in 2021, just by the nature and the difference of the products, will launch crypto brokerage, but I do suspect we'll see 2 or 3 very large mainstream firms leveraging the Paxos infrastructure to launch stablecoins.
We talked about how much the market has matured, but to be sure, there are some elements of crypto market structure that could use some work. There's a gentleman in the question chat section raising the question of disparities within price. And this is something we've definitely seen as Bitcoin has run up above 20,000, price dislocation where the asset is trading maybe $50 or $100 off relative to another exchange. Sina, in your seat at FTX and its partner firm, obviously Alameda, sitting at the center of this market's liquidity, spreads have tightened, sure, and arbitrage opportunities betwixt exchanges have tightened, but this idea of what best price is and this idea of improved liquidity, has that gotten better? Or how would you describe the evolution of that?
It's a great question. So as somebody that also comes from the traditional world, from both Morgan Stanley and Credit Suisse, we're in the traditional world, we're sort of accustomed to this concept of MBBO, and in crypto, of course, that doesn't really exist yet. That said, it is getting better, and I would just say that these are still nascent markets. I mean, it's we're, despite what the price action sort of would have us believe, or what sort of might make us think, these are still very young markets, and I think I would just point to sort of this old adage that in the short term markets are inefficient, but in the long term markets are generally more efficient. And I think that we're just generally moving in that direction, but we're just we have a ways to go before we get to where the crypto markets sort of resemble certain sort of more familiar elements of the traditional markets. So we're not quite there, but we'll get there.
If it's not sort of the market infrastructure that's the biggest impediment to getting new entrants in and preventing them maybe from developing their own digital asset strategy, is it maybe regulation then? There's been a lot of talk over the past couple of days. I'm sure you guys have heard some of it, potential actions from Treasury Secretary Mnuchin. We're not exactly sure what that action would look like. It seems like he's unhappy with maybe the lack of travel rule implementation among crypto exchanges. Is regulation an issue? Caitlin.
Taking myself off mute there. Yeah, sure it is. Again, the big institutions, when I say big institutions, again, I'm talking about pension funds, ERISA plans that have the highest level of fiduciary standards they have to meet, as opposed to hedge funds. If you think about the spectrum of institutions, a lot of people talk about institutional interest in crypto, and it really has been small hedge funds and family offices mostly. It's starting to get into those more traditional asset owners that have true fiduciary responsibilities, that have to meet unbelievably high standards. I spent the majority of my career as an ERISA fiduciary. I've been personally sued for billions of dollars twice. As ERISA fiduciaries, you are personally liable, okay? So this kind of stuff tends to focus the mind, and the fiduciaries pay a lot of attention to the details. And so they cannot take the kinds of risk of playing in gray areas because they've got personal liability. So this is the reason why it takes a while for pensions and endowments and foundations, the more traditional long-only type asset owners that have those high fiduciary standards, to come in. And absolutely, they do want to deal with regulated players. They have to, because of the fiduciary obligations that they have. And so they are not going to be the first movers, and they're looking for clarity, and we don't have it yet. Just that whole SEC reopening what is the definition of qualified custodian, and does it apply to Bitcoin? Is that's something that some will wait until there is clarity, or they will just hire a bank, because a bank by definition is a qualified custodian. There's not a question about that, but now there are questions as to whether trust companies are. And that's just one example of the kinds of uncertainty that I think this is why we're still at very, very early stages. And so the retail customers, of course, can take the regulatory risk. They don't care. And they don't care about the gap accounting. They don't care necessarily about the tax reporting obligations too. But every institution that has to be very careful about compliance or accounting or audit standards for themselves, they have to pay attention to that, which is why the regulated piece of this is important to them.
What about from your perspective, Andrew? Is the regulatory impediment what's keeping you from launching a crypto exchange at Morgan Stanley tomorrow? Or is it something else? That's just a joke, by the way.
I mean, definitely look, obviously, to regulators for clarity and have in-depth discussions before even considering taking any further steps towards any activity in this topic, as I'm sure Caitlin can definitely attest to in far better detail than I ever could. I mean, I think it's fascinating outside of the US. I'm, as I mentioned, based in Zurich in Switzerland. There's two fintech, or let's say pure digital banks, that were granted banking licenses here from FINMA last year. So you have Signum Bank, we have Sabre Bank, and we recently saw even some other banks such as BBVA announce that they will launch a crypto digital asset custody solution out to Switzerland. So we've seen some jurisdictions globally start to see there is some potential to change the traditional financial market infrastructure by being supportive for new technologies and new ways to implement banking on a new type of technology. But we're not. We are certainly, as a large US organization, very much very focused on the US regulatory environment for this topic.
Mm-hmm. And what are the big questions, Walter, that still hang over the space from a regulatory perspective that maybe are drawing clients to your firm rather than building within their own company?
Yeah, well, I think, Caitlin mentioned a bunch of them. I think that the tax questions, the accounting questions, some of these things that are not always front and center, but as you get into the depths of these huge institutions that are protecting really big businesses, there are, people whose job it is to raise their hands and say, hold on a second, we figured this out. And, so I think that those all come up. I would say that when we are talking to clients and our potential clients, the one thing that really makes a difference for is the best indicator of how quickly it will move or how significant the roadblocks will be is if they have direction from the most senior levels of the organization. When it's born in the kind of digital strategy or the innovation department, these are often the groups that are really tasked and ultimately responsible for moving everything forward. However, if they don't get that clear direction from the top, some of the hurdles along the way become insurmountable or really significant delays. So that's one of the differences that we've seen in overcoming some of those common topics.
I think that's totally correct. I remember when I was at Business Insider reporting on the space and Robinhood launched their crypto strategy. The CEOs at the time visited the office and kind of unveiled the plan, but you could tell that they had major buy-in. This was their vision. If you don't have it coming from the top, in many cases, it's kind of a moot point and dies when the interest goes away. Maybe that's why we saw so many banks and other institutions pull out. You have someone like Ray Dalio at Bridgewater, who's kind of having a change of heart type of process. And it's going to take something like that to actually get maybe a firm like Bridgewater to end up allocating to the space. Sina,
yeah, I might just add to that, like in the financial services and the fintech side, two great examples of that, in addition to Robinhood, would be you had Square, Jack Dorsey, obviously unbelievable and unwavering leadership into the crypto space, kind of incredibly early when you look at it against firms like that. And then still today, the leaders that are bringing their companies into the space are really showing incredible leadership. Dan Schulman, the CEO of PayPal, that press release that they came out with a couple months ago when they launched their crypto product was, a really strong endorsement, not just of what they were launching, but where they were going with their crypto. And I can tell you that will help organizations move and overcome and solve some of these challenges that can still be tricky to solve. And them solving them ultimately will allow others to solve them. So now we're seeing all types of fintechs that otherwise may have been caught up on these issues. They're all able to move forward. And I think that there is a kind of a customer archetype that might exist for these financial institutions and banks. And when one or two of them solve them, I think it will come from great leadership in the organizations, then we'll see a lot of others move very quickly too in a very fast wave.
What is the easiest way for a digital asset strategy to fail, Sina? What don't you do?
Oh gosh, I guess what did Michael Jordan said? Somebody said you miss 100% of the shots you don't take. So I think the only thing that would be totally wrong would be not to have any digital asset strategy. And just to dovetail on what Walter was saying a minute ago, I think a lot of what we're talking about in the context of large corporations, other sort of significant players, there's a certain element of human nature or sort of animal spirits or whatever you want to call it that people tend to sometimes hesitate to do new things. It can be kind of the unknown can be a little bit daunting for people individually, and then also that kind of gets amplified in the context of corporations, regulated corporations in a regulated space and so forth. So I think it's absolutely true that you do need very strong leadership from the highest levels of any particular company that wants to get involved, because you're going to need that to see it through. And then I think, like you were saying earlier, Frank, like if there is a dip in the price and people are less interested, you need to have the staying power, and that comes from like an emotional place, an emotional buy-in that I think you're seeing more and more of, like Walter was saying also. So I guess to answer your question more directly, I mean, the only glaring thing that I would say is, sort of ignoring digital assets. At this point, I think it's clear that would probably not be the optimal approach.
Mm-hmm. Caitlin, what say you?
Yeah, I fully agree. And there's another piece of it as well. And this gets back to your question earlier, Frank, about the institutionalization of it. When folks dig in, when the risk managers dig in and look at how OTC trading happens in this space, it is by Skype usually, and the parties give each other 24 hours to settle. And that's the kind of thing that makes risk managers go, whoa. Very few players are even offering APIs right now. So there's nothing automated about it, and it's hard to have an audit trail. So those kinds of things are, again, getting fixed. We're at such early stages. Now there are a couple of the trading firms that are offering APIs, so you actually can have an audit trail. And but little things that haven't been solved yet that, for example, Avanti's working on, is right now, it doesn't, there are no players that exist in the United States that, certainly in Switzerland, Andrew, to your point, they do. Switzerland is further ahead than the US. But what I'm talking about is banks that are directly plugged in for payment clearing services to the central bank and custody digital assets. That does not exist in the United States right now. What's the impact of that? It means, therefore, that the digital asset leg of your trade has to settle in a different legal entity than the US dollar leg of your trade. This is the reason why stablecoins got invented in this industry. They needed something that settled with on the same settlement cycle as crypto and with settlement finality. But the problem is those are not issued by banks, and they're in a legal gray area. These are the problems with stablecoins. Legal gray area, not clear it's legally enforceable, not clear where it fits within commercial law. Also, the accounting, is it an investment or a receivable as opposed to is it a cash equivalent? Those are the kinds of things that need to get settled before institutions can come in and start using stablecoins. And so en masse, again, they are being used by smaller institutions, but I'm talking about the really big money, corporates, corporate treasurers and pension funds and the like. And that stuff is still getting settled. And to the extent that we can actually bring the banks like in Switzerland to the market that can settle both legs of the trade within the same legal entity, then not only do you handle the counterparty risk issue, which is what the risk managers at the big players care about, of course, but you also handle the unsettled trade exposure issue. Again, small firms that don't have VAR models are probably not going to care about the fact that the trade's settling 24 hours later, and there's an unsettled trade obligation for that 24-hour period. But the big players absolutely care about things like that because they have to, it basically eats up their trading capacity to have an unsettled trade. So if we can get to the point where we're now starting to speed up the settlement cycle with real dollar settlement at the same time as real crypto settlement, then all of a sudden the institutional world, I think, really takes off. And that's one of the problems we're working to solve.
Mm-hmm.
And Frank, if I could just add to that real quick,
Yeah.
Totally agree with what Caitlin was saying. On the theme of sort of what organizations might overlook is a lot of these operational details, because precisely because it is so different than the traditional world that a lot of people are more used to. There's all these sort of intricacies that may not be, in fact, I'm almost certain for most firms are not immediately obvious. And so I would just underscore that it highlights, in my opinion, the importance of having a partner or having somebody that you can work with that helps you see around corners, helps you understand how do you deal with float, how do you deal with liquidity management, what kinds of edge cases are there, what can go wrong on a trade, and so on and so forth. And so you really need somebody to sort of be your Sherpa or be your guide, I think, if you're not a digitally native organization, I would say.
Mm-hmm. They can have Andrew be their Sherpa. What do you think?
I would echo that. I mean, to the point on USDC, for example, being adopted by Visa, I thought that was quite a fascinating evolution of the whole stablecoin topic. And of course, Paxos working with PayPal, we start to see more and more of these mergers between the traditional players, at least in the payments business. I wouldn't say in the banking business, but in the, let's say, legacy payments business, collaborating with some of the more innovative stablecoin issuers or digital asset service providers. So there's certainly a lot of that happening at the moment.
Yeah. Well, I guess we're getting towards the end of the session, so I guess we can leave it with maybe some of our, predictions for the next year. We can put out our crystal ball. I think this might be the last webinar at least I have slated, unless they unless they decide to throw another one at me. But I'd be curious to know what you guys are expecting for the new year, maybe in a contrarian expectation. We can start with Sina, since he's right next to me on this.
Sure, so I'm muting myself. I don't know if I'm contrarian in this particular situation. I would say that, look, I mean, with names like PayPal, JP Morgan, Wells Fargo putting out reports on crypto, I think that a lot of the hesitation to get into this space are like, not just gradually, they're like very swiftly being removed in terms of the reasons for sort of not participating. So I suspect you're going to see a lot more large name, household names, whether that's traditional financial services companies, fintech companies, maybe some general sort of technology companies, realizing that crypto represents a new way to communicate value. And so I think a lot of companies are going to start to take advantage of that and see how that can benefit their customers. So I think you'll see a lot more big names coming into the space, some of which might surprise folks and some of which might be expected.
Get one.
Yeah, I think we don't even know what's going to happen yet when a true bank gets in the United States with the US dollar able to provide services to the digital asset market. The innovation that's going to come from that, and the magnitude of institutional adoption, with the comfort level of knowing that there is an institution that is not only regulated as a true full bank, but also can provide custody services and clear payments directly at the central bank. That is, I think that's going to be a game changer, and I don't think most folks yet fully understand the magnitude of that, and having that be available on an API-based open platform is going to be really powerful and exciting.
Thank you. Thank you for your answer. Walter.
Well, on the contrarian side, I think I agree with a lot of what Sina and Caitlin said, so I guess those aren't contrarian. At least I can't say them now. But those are maybe contrarian ideas I agree with. I think that one thing that we'll see in this next year is 2020, we obviously saw an enormous explosion in the number of stable coins, and maybe even in some limited expansion use cases in stable coins through primarily DeFi. I would say that in 2021, that will continue, and I don't think you'll have many people debate that, given what the world looks like right now, and given the kind of expanding use cases, the new entrants. But I think that what we'll see what will steal the show in 2021 will be other real financial assets being tokenized and used in interesting ways, and see a large value, billions of dollars of traditional financial assets, whether it's gold, whether it's securities, being tokenized.
I already know Andrew, so I'm just going to say it for him. It's that the block's going to get acquired by Morgan Stanley for $100 million. I'm going to finally get to retire in Hawaii.
You already have the shirt ready to go, Frank.
Well, I'm in Florida right now, but the next step, the classiest step, is going to be Maui. So,
okay.
Your prediction, sir?
Prediction. So I would say an escalation, or let's say an evolution of this current momentum in terms of the traditional, or let's say significant interest in the topic will continue throughout 21. I've been monitoring the explosion of DeFi to Walter, as Walter mentioned it as well. A fascinating space. Technology's moved on hugely since the days of Ether Delta in 2017. We start to see the likes of Sushi Swap, yield farming, pickle finance. I find the creativity with food types and the icons used just fascinating. Let's put a controversial one out there. We'll move on from food types because we'll run out of food types by the end of 21. But this will just continue to evolve, and the concept of non-custodial wallets and DeFi, of course, in focus with the Treasury Secretary, as you mentioned, Frank. But I think in the same way that the ICO phase of 2017 led to an evolution to capital raising or distributed capital raising, I think some of the technology from this DeFi phase will certainly be utilized in some way in a more regulated manner throughout 21 and towards 2022.
What do you think the main use case there is? Trading, lending? What about the DeFi world do you think will sort of rise to the occasion?
Yeah, I mean, it's still very, very early. Just looking into it, I mean, the growth is phenomenal, and obviously with 15 billion plus of assets, it's not insignificant. And I think a few months certainly in August or September, the volumes on Uniswap were larger than some of the crypto venues. So that shouldn't be ignored. And I find the programmable features of the technology, the ability to have a smart contract monitor when a certain payment should be made or a certain action should be taking is revolutionary. It's fascinating. And I think the application of some of those programmable features which are born out of this DeFi world and all this innovation could have huge effects for the future of finance and the ability to be far more efficient on a new type of digital infrastructure.
We shall see.
We shall see.
Thank you, everyone, the folks who have tuned in, and especially our panelists for joining us. This was a great conversation. I'm sure we'll have many in the new year. Until then, Merry Christmas, Happy Holidays, and take it easy. Thank you for joining us.
Merry Christmas.
Thanks.
Thank you.
Cheers.
Thanks all. Happy holidays.
Thanks, Sina. Cheers, Caitlin.